Welcome to this episode of CalCPA's Tax Bill Series. I'm Melody Thornton, CPA and Partner at Fitzgerald and Company LLP. In this episode, I will talk briefly about the research and development expensing, breaking down the key update and what it means for you and your clients. As you've heard many times, this is a part of HR 1, the One Big Beautiful Bill Act that was signed into law by President Trump on July 4th, 2025. And the section I'm talking about today is 174A, Research and Development Expenses. 174A provides a deduction for domestic research and development expenses paid or incurred by the taxpayer during the tax year. This provision reverses the required 5-year amortization that came into play under the Tax Cuts and Jobs Act, in which beginning in 2022, taxpayers no longer had the option to fully expense R&D expenses in the year incurred, but instead were required to amortize over 60 months. Now, this section 174A is attributable only to domestic research and development expenses. It is not applicable to foreign research. For foreign research, the law is the same and has always been the same, that those expenses are amortized over 15 years. So we are strictly talking about the changes to domestic research and development expenses. The changes made by the provision are treated as a change in method of accounting. As such, a Form 3115 will need to be filed. The accounting method change is treated as initiated by the taxpayer with the IRS's consent. The change is applied on a cutoff basis only, so there is no 481 adjustment. 174A does make the following clarifications. Software development expenses are subject to R&D expensing. However, land improvements, oil and gas, other minerals, any expenses related to that are not subject to R&D. And as under prior law, any R&D expense deduction is reduced by the amount of any Section 41 R&D credit that is allowed and claimed by the taxpayer. Just as prior to TCJA, taxpayers are not required to expense R&D in the year incurred. They do still have the option to make the election to capitalize and then amortize R&D expenses for up to 60 months. So they could actually choose a period less than 60 months and still not expense fully in the year incurred. However, and that election, if it's made, is made on the tax return and can be made all the way up to the date the tax return is filed, including extensions. The method selected and the period selected by the taxpayer shall be adhered to for the tax year of the election and all subsequent tax years unless the IRS consents to a change in method of accounting. But assuming that your clients want to fully expense the R&D in the year the expenses are incurred, for those taxpayers that meet the 448C gross receipts test, meaning they're a small taxpayer, and their gross receipts are $31 million or less in the tax year after 12/31/24, they have the option to go back and apply 174 to to R&D expenses incurred after 12/31/21. So the 22, 23, and 2024 tax years that required amortization over 60 months, those returns can be amended and the deductions claimed in full in the year incurred. Taxpayers can make the election within 1 year of the enactment of the bill. So they have until basically July 3rd, 2026 to make the election to go back and amend their tax returns for 2022, 23, and 24 as applicable if they're to the extent they're impacted by the election. Now, for taxpayers with gross receipts more than 31 million, and for small taxpayers who don't want to go back and amend, maybe they had changes. For instance, a number of my clients are S corporations, and one in particular had a couple of changes in shareholders in that period. And so they really are not interested, even though they were capitalizing a couple of $1 million per year and they weren't happy about paying the taxes. They really are not interested in going back and amending those returns. For those taxpayers, for the large taxpayers and the small taxpayers who do not want to amend, there are two options for amortizing the remaining amounts that were capitalized in 22, 23, and 24. And those options are, first of all, they can deduct the remaining amount in full in the first tax year after 12/31/24, or they can ratably deduct over the next 2 years, 4 years, then beginning after 12/31/24. They can either expense it all in full, the remaining amount, or they can add up the total and deduct 1/2 in 2025 and 1/2 in 2026. Now, clearly, there are a lot of questions, particularly about amending, but so the IRS will be publishing guidance and there may be regulations issued. So I really view this session as being preliminary. And I anticipate that we're going to want to come back to this topic when we get some guidance from the IRS. Thank you very much, and I hope you have a great rest of your day.